RHI Magnesita is global refractory producer. Refractory products are used as heat shields, mostly on steel production and in production of cement, glass, aluminum and copper as well. Steel manufacturing consumes the biggest number of refractory products, and steel producers account total of 70% of RHI Magnesita's total revenues. They are listed in London and Vienna stock exchanges. The market cap is currently 1.05 billion pounds or 1.22 billion euros. So it is a relatively small business in quite unknown industry, which means that there are likely not too many people following the stock. I will be using euros for the stock valuation as their financial statements are translated in euros. The entire refractory sector's annual revenues are 20 billion euros. In 2017, RHI merged with South American refractory producer called Magnesita, and they became the market leader with 15% market share or 30% when we exclude China. Overall, the sector is very fragmented, full of small players. Part of their strategy is to acquire smaller producers, and as the industry consolidates over time, they can hopefully increase profit margins. Their revenue mix is global from all around the world. They are also vertically integrated, meaning that they own low-cost magnesit and dolomite mines that cover approximately 50% of their raw material needs. This, on top of their market size, gives them competitive advantage, especially during times when raw material prices are high, like it was in 2018 when their own raw material production contributed additional 5.5% EBITDA margin. While the steel manufacturers and iron ore miners are extremely cyclical businesses, refractory manufacturers' EBITDA margins are much more stable. During recessions, the steel production doesn't usually fall significantly. Only few percentages demand drop will crash the iron ore and stainless steel prices, but the total production volumes don't usually fall that much, which means that the refractory product manufacturers can still make decent profits even during recessions. Although in the past 20 years, all the additional steel demand has grown from China, but currently the Chinese real estate sector is like a massive Ponzi scheme. And it is just a matter of time when it is going to collapse. On top of that, the Chinese Communist Party has invested heavily in infrastructure projects that don't make any economic sense, just so they can boost the GDP numbers. So if they'll end the crazy infrastructure investments at some point, it will lead to massive demand gap in steel consumption. But then only 6% of RHI Magnesita's sales are going to China, and in the refractory industry, you want to manufacture locally near the customers because otherwise transportation costs and tariffs make your products quickly uncompetitive. So in case Chinese steel demand crashes, it would cause many local refractory producers bankruptcies, but I don't think those Chinese producers could flood the global market to also crash the global refractory product prices. So in 2018 and 19, they made around 3 billion euros in revenues. They made 158 and 139 million net incomes for their shareholders during those years. Even they had 22 million and 112 million restructuring charges and 81 million and 17 million foreign exchange losses. Without the restructuring and forex losses, they would have made something around 300 million net incomes for both of those years. However, in 2020, when steel prices fell, their revenues also fell around 30%, and their margins fell because of lower sales volumes and lower commodity prices, which meant that their own magnesit and dolomite production didn't give them as great cost advantage anymore. Also, the management claims that their sustaining capex is around 85 million euros annually, while depreciation and amortization expense was between 120 to 150 million annually. So if that is true, their actual owners' earnings should be around 35 to 65 million more than what is their reported accounting earnings. However, as I can see how they are separating the growth capex from maintenance capex, I cannot just take their word for it. Now, in the first half of 2022, they made 1.6 billion euros in revenues, leading to 3.2 billion in annualized rate if the second half is like the first one. For the first 9 months of 2022, steel prices were high and the steel industry was very profitable. However, the steel prices started falling in the fourth quarter significantly as there seems to be a slowdown in demand. So next year, their revenues are likely going to fall again and the profitability will take a hit. Also, when looking at 2022 adjusted EBIT margin, which excludes restructuring costs and write-offs, their margins are still well below the 2018 and 2019 levels, as in those years they benefited from extremely high manganese prices, but that kind of profitability is not expected going forward. Their capex peaked in 2021, so going forward, they will have more available free cash flows to either pay dividends, do buybacks, or make business acquisitions. In 2021 and 2022, the cash flows were massively negative, firstly because of high capex, but more importantly because of their working capital increases, as raw material prices went up, and they also accumulated more inventory to combat the global supply chain challenges. If you adjust the free cash flows before working capital changes, then the 2021 and 22 free cash flows were still positive. Now, going forward, they will start reducing inventory levels and capex is also going down, so more free cash flows in the future. Shareholders' equity is 1 billion euros, which isn't far below the current market cap. However, more than 400 million of that equity is goodwill and intangible assets. Their net debt is almost 1.2 billion euros, which is quite high. However, most of it is used to finance their inventory, and the net debt levels went temporarily up as they increased their inventory levels in the recent years, and the current working capital is 1.35 billion positive. If I deduct the current assets from current liabilities, long-term interest debt, and pension obligations, that will lead to negative balance of 500 million euros, which isn't that much anymore. So yes, this business does have high debt levels, there is no way around that, but most of it is used to finance their inventories, as it is simply business where you need good amount of working capital. Their working capital increased almost 600 million in the past year, so after they scale down the inventory, then the balance sheet will also look a bit healthier. When looking at their debt profile, most of their debt is fixed interest rate debt and no major debt maturities in the near future. Also, they got plenty of liquidity, so no problems on the financing side. In the first half of 2022, they did more than offset the inflation with their price increases, leading to extremely profitable first half. Also, while the global steel production fell by 5%, RHI Magnesita increased their volumes by 4% and gained additional market share. This just shows that they have competitive advantage over the small producers. They also keep increasing the solutions mix in their revenues each year, already being 32% of their total sales volume in first half of 2022. With their solutions business, they are trying to optimize their customers' refractory usage so that both parties save money in the end. I really don't understand how that solution business works and what is the competitive advantage there, but the solutions business is something that not all of their competition is offering, and they keep increasing their market share, so it seems to be working. As you can see, about 10% of their revenues are from India. I found out that their Indian subsidiary, which they own 70%, is listed on Indian Stock Exchange. So remember, RHI Magnesita, the entire company, listed in London Stock Exchange, is valued at 1.22 billion euros. And the Indian subsidiary, of which they own 70% and which accounts only for 10% of their total revenues, is valued at 125 billion rupees, which is 1.45 billion euros. So their 70% stake of that 1.45 billion euros market cap is worth more than 1 billion euros. If I deduct the India business from RHI Magnesita's valuation, you can then buy rest 90% of the business just for 200 million euros, or with price to earnings ratio of 1. Now, of course, I think that their Indian subsidiary valuation is crazy and totally wrong, so I can't use that valuation for their Indian business when I'm valuing RHI Magnesita. It just shows more how inefficient and lazy stock market can be, which is great news if you're a value investor. I just wonder if there would be anyone in India willing to actually pay that price for their entire Indian business if they tried selling it. Or would the management be willing to even sell their Indian business, as lately it's been their focus to grow their business in that region. If they found a buyer for that business with the current market price, well, that would be a quick way to double the stock valuation, but I don't really see it happening. In 2019, they started their strategic initiatives plan to achieve 100 million cumulative EBITDA improvement by 2022 from cost savings plan and additional 40 to 60 million EBITDA from sales strategy plan. Now their production optimization plan is almost finished, except for a few delays in Brazil that will be completed by 2023. So they are planning to capture additional 150 to 170 million EBITDA by 2023 from this strategic initiative plan. However, they should have already captured majority of the EBITDA improvement in 2022, but when I'm looking at their 2022 financial statements, their underlying profitability, even excluding the vertical integration margin from their own raw material sites, isn't any better than what it was in 2018 or 2019. So all I'm wondering is that as they should already have more than 100 million EBITDA savings run rate in 2022, where did all the benefits disappear as margins haven't improved? And it's not like the overall industry margins went down, because when I'm looking at their competition, they are all making large profits right now. So let's see if they can actually get some additional EBITDA benefits as they finish their strategic initiatives plan by 2023, but take their promises with grain of salt. When it comes to capital allocation, they pay around 30% of the net income in dividends. Then they are using rest to either organic investments, acquisitions, or share buybacks. For the investments, they are aiming to achieve double-digit returns on invested capital. So I think this company will make on average something between 2.7 billion to 3 billion euros in revenues. Let's say the average revenue is 2.8 billion euros. Then RHI's historical EBITDA margins were on average around 12%. However, in 2017, they merged with Magnesita, which was always more profitable company, and it increased the group revenues by 25%. So let's say that after the merge, their average EBITDA margin rose to 13%, and then as they achieved synergies and executed the strategic initiatives plan, let's add one more percentage to their long-term EBITDA margin, making it to 14%. Depreciation and amortization expense is going to be 150 million. However, the management team is saying that the maintenance capex will be just 85 million annually. I'm not going to blindly trust the management maintenance capex, but then I believe it is lower than their current depreciation and amortization expenses, as this is not a growth industry anymore, but stable cash flow business. So I'll meet somewhere in the middle ground, and I'll assume their maintenance capex will be 120 million annually, just to be a bit more conservative. Interest cost will be going up. Currently, it is about 20 million annually, and much of their debt is fixed. However, over time, it will go up significantly, so I just calculate it with 40 million annual interest expense. The average tax rate is somewhere around 25%. As they are operating like in 100 different countries, you can't know exactly, but the historical average was around that level. This would leave average annual earnings of 174 million. As the market cap is 1.2 billion, RHI Magnesita is currently trading at long-term average price to earnings ratio of 7 if these earnings assumptions are correct. So I'll assume average earnings to be 174 million euros in my valuation model. They'll pay out 30% of the earnings in dividends. The holding company is Dutch holding entity, so it does have pretty good tax treaties with most jurisdictions. I'm too lazy to read out all the tax laws now, but I think from most jurisdictions they should be able to distribute profits to the parent company without paying additional withholding taxes, and in some jurisdictions they may have to pay like 5 or 10% withholding tax, but overall it is quite tax efficient corporate structure. Then, depending on if your dividends are taxed or not, you have to add your dividend tax rate on top of it to make the valuation model correct for you. If you want that I leave download link to the valuation models I'm making in these videos, let me know in the comments. So they'll pay 30% in dividends and then invest rest of the profits to growth, achieving 10% return on invested capital. It's 50 years valuation model without any terminal multiple, and discount rate used in it is 10%. Based on this model, I'm getting valuation of 1.6 billion euros compared to the current stock price of 1.2 billion euros. Why is the stock trading so cheaply then? That is probably the biggest question I struggle to figure out. Maybe it's because the stock is a small cap in relative unknown industry, so people just haven't figured it out. Or maybe it is because everyone is expecting global recession, so we know that their profits will likely fall in the next couple of years, and as their profits are expected to fall, people are expecting the stock price to also go even lower, even though it is already cheap. Maybe also many investors are currently more attracted investing in iron ore miners or steel producers, as many of those are currently trading at price to earnings ratios between 2 to 5, while they fail to recognize that iron ore miners and steel producers are much more cyclical businesses than refractory producers. I don't know. These are the reasons that I'm thinking, but maybe I'm totally missing something. If the Chinese construction sector collapses, maybe the Chinese refractory producers flood the global market so that nobody won't make any money over the next 5 years until there are enough bankruptcies and the demand recovers. I don't think the Chinese manufacturers could compete with all the extra transportation and tariff costs, but maybe I'm wrong. Anyway, to me this already seems like a good investment, and I think the market only sees the likely upcoming recession and a couple of years lower profits. So why bother investing there, as there is not any catalyst to immediately shoot the stock price up. But maybe it's the key to buy it before no one sees the catalyst to make the stock price go up, because when people see the catalyst, then the stock will be already priced higher. Anyway, that's so cool if you watched all the way to the end. Let me know in the comment section what do you think.